Gautam, you can go.
Hi everyone. Thank you for joining us yet again in a third part of the series on raising your first round of funding with Surge and Sequoia Capital. Today we're back with some of the leading voices in the ecosystem, in the venture capital and investment ecosystem, angel investors who will tell you what they are looking, the qualities they are seeking in startup founders. And likewise, what should be the qualities you should be looking at your investor when you're pitching to them? Like, how do you find the right fit? Who are the investors who can actually help you with more than just money, with strategy and with like a lot of, smart money? So I'll hand over the session to our moderator for the day, Mr. Rajan Anand, to take this forward. Rajan, please.
Great, thank you, Gautam. Hi, everyone. It's great to see all of you back. So greetings to all our seed stage startup founders who are dialing in. And also I wanted to welcome our two guests for today, Alok Mittal and Shanti Mohan. I'm going to introduce them in a minute. As all of you know, this is the third part of a four-part webinar series that's organized by Startup India and Surge. And before we get into the specifics of the discussion today, I wanted to spend a few minutes talking about what this is, webinar series, and also just remind everybody that what we covered in the first and second parts. So firstly, as all of you know, Startup India was launched in 2016 by the Honorable Prime Minister, helping accelerate and promote the startup ecosystem of India. And I say over the last 5 years, the kind of progress that we've made in the startup ecosystem has been absolutely extraordinary. And we have a lot to thank to the Startup India initiative. Gautam is part of that team. We've got a large team that have been a part of the Startup India team, and they've been very focused on all the aspects of health, the innovation and startup ecosystem in India, everything that ranges from policies that are tied to startups to enablers such as incubators, accelerators, and so on, all the way through knowledge sharing initiatives such as this, a large number of them, as well as creating. There the slides have just shown up. So if you go to the next slide, we're on the Startup India slide. I don't know who's moving the slides, but either Alicia or okay, Alicia or Payal, are you okay? It's fine. I just leave. Okay, sorry guys, we have a slight technical problem here. As all of you know, so Startup India has been extremely successful. One of the major initiatives as part of Startup India was the 10,000 crore fund of funds, where 10,000 crores is being deployed through SIDBI to domestic venture capital funds, with the objective being to promote the domestic venture capital industry. And a large number of initiatives have been taken by Startup India over the last 5 years to promote the startup ecosystem. So that's Startup India. And then Surge, which is Surge, whom I represent here, is basically Sequoia's early stage program that we launched for seed stage founders, which combines capital, where we provide $1 million into very early stage companies, as well as significant company building support that ranges from helping companies sort of think through their products to helping them get to product market fit, all the way through helping them build their teams, work through their sales, go-to-market strategies, marketing strategies, all the way through helping them raise their next round of financing. So we launched this program actually in March of 2019. So it's about 16 months. And we basically focus on taking 15 to 20 companies, partnering with 15 to 20 companies for every cohort. We run 2 cohorts a year, so we're currently in our 3rd cohort. And over the last 16, 17 months, we've partnered with about 52 companies. And in those 52 companies, we've invested over $100 million just from Surge. And those 52 companies actually were like 37 companies which are part of the first and second cohort, then went on to raise another $250 million over the last 16 months. So far, we've been very, very happy to see the progress of Surge. Still very, very early days. We are also a startup, but it's been a program that we launched because of the major gaps that we saw in the startup ecosystem, right? Gaps around not having enough capital, not having enough mentoring, not having enough learning, and also not getting the kind of hands-on support. So that really is Surge, and this series, together with many other things that we're doing as Surge, are all meant to really help seed stage founders in the ecosystem on various aspects of their company building journey. We obviously have 15 or 20 companies per cohort that we work with very, very deeply and closely. But for the broader ecosystem in India as well as in Southeast Asia, we're doing a number of things online these days. And this particular series we launched because we felt that a lot of seed stage founders could do with understanding they should go fundraising in a much deeper and much profound way. So that's the reason that India and Surge part to actually do this series. As I said, this is the third part of a 4-part series. The was focused on everything from should you raise funding at all if you're a seed stage founder, to who should you approach to be raising seed stage funding, how much should you raise, how should you think about how much you should raise, as well as a first cut of what investors look for as you're trying to raise your seed round. The second, so that was sort of 3 weeks ago. And then last week on Saturday at 4 p.m. same time, we had Peter Kemps, who's one of our senior investors on the Surge team, come and speak about the perfect pitch, right? So hopefully all of you, many of you were able to dial in last week, where Peter actually went through a very comprehensive set of thinking and actually sharing lots of examples of what an actual pitch deck looks like, and then also shared some do's and don'ts as you pitch to investors. So that was sort of the part 2 4-part series. And today we're thrilled to actually bring to you stories from the trenches. So we have 2 terrific and prolific practitioners from the seed stage investing ecosystem who joined us today. And what we thought we'll do today is, really bring it, and both for me to actually spend some time asking both Shanti and Alok a set of questions, but also give all of you an opportunity to ask questions from them. So before I start, let me introduce both Shanti and Alok. Thank you very much for joining us today. It's wonderful to have you guys here. Let me start with Shanti. Shanti, by the way, both of them, if you're a founder in India, and Shanti and Alok, we do have some founders who are also dialing in from other parts of Southeast Asia and also some parts of South Asia, places like Sri Lanka, Bangladesh, and so on. But for those of you in India, I'm sure if you're in the seed stage ecosystem, you're very familiar with Shanti and LetsVenture, as well as Alok, who's a very, very active angel investor as well as a serial entrepreneur. So let me start with Shanti. Shanti is the founder and CEO of LetsVenture. She'll talk more about LetsVenture, but LetsVenture is Asia's largest curated marketplace for startups and early stage investors, seed stage investors, or angel investors. Shanti launched this company a couple of years ago. Successful. She's going to share with you how much traction they've got. But we're delighted to have her. Shanti is a serial entrepreneur who actually started and sold a previous company to HP, spent some time at HP, and then left again to address again what she thought was a significant gap or pain point that we had in the Indian startup ecosystem. So we're thrilled to have Shanti. She'll share with you what the platform does, the kind of activity that they have, and also in this period of COVID, how busy they've been with seed stage investing, because I know one of the questions that all of you have is, are investors still investing despite being in the COVID period? So welcome, Shanti. And then I also want to invite Alok Mittal. Alok Mittal is both a serial entrepreneur as well as a very, very seasoned early stage investor, both seed as well as venture stage investor. Alok Mittal currently is the co-founder and CEO of Indifi Technologies. Indifi is one of the leading SME-focused fintech startups in India. Alok started this about 5 years ago. Prior to this, Alok has a long career in both entrepreneurship and investing. Alok actually started and then very quickly became an entrepreneur, launched a company called jobsahead.com, which was one of the early companies in the online employment space. They sold that company to monster.com. I think all of you know Monster. So Alok's first company, he sold to Monster. Then we went on to lead Kanaan Partners, which is a venture capital firm, very large venture capital firm for almost a decade. Alok was a full-time venture capitalist, and then started off. That's only part of Alok's, which is why we thought he would be very relevant to have him here with us. He's very active, and he's also one of the co-founders of Indian Angel Network. And those of you in India, I'm sure, are very familiar with Indian Angel Network. Indian Angel Network now is the largest angel network on the planet, right? So it's we should all be very proud that the largest angel network on the planet is an Indian Angel Network. And by the way, one of the reasons it's so large is because it's no longer Indian; it's actually very global in every context. So welcome. That's Shanti and Alok for you. Welcome to both of you. So getting started, what we to do is tell us a little bit about, Shanti, maybe you can start and tell us about LetsVenture. What is LetsVenture? Exactly how does it work, especially since everybody who's dialed in today is a seed stage founder. Either they're looking to raise seed funding or they will be over the next couple of years. And also maybe specifically on, what are you seeing over the last 90 days as we've been in COVID? Because one of the questions we get often is, are investors, especially seed stage investors, be they angels, be they seed funds, be they venture investors? Let's start with you.
Yeah, thank you, Rajan, and thank you for having me on this webinar. Just to correct you, I did not sell my company to HP. I actually exited and then joined HP as an employee. So just wanted to make sure that I don't say that I got acquired by HP. But on LetsVenture, we were founded in 2013, and at that point of time, the ecosystem was very nascent, and the intent was to create an online marketplace where we could make the process of discovery and syndication and the paperwork closure easy for both founders and for investors. So that was the intent. So really looking at a two-sided marketplace. And it has been a very interesting journey. In the last 7 years, we've kind of, on the early stage platform, we've done today about 271 deals on the platform. And the startups have gone on to raise 1,020 crores. So we've crossed the 1,000 crore mark today. And as we also built out LetsVenture in the last 2 years, we also built something called LetsVenture Plus, which is a growth platform where we also connect startups who are looking for growth stage investing to family offices. So today we have about 200 family offices on the platform. But on the early stage side, we have about 30,000 startup founder profiles. So every month we get about 300 to 400 founders who come and create profiles on the platform. We have about 7,000 investors from 55 countries. So it has been a very, very organic word of mouth referral kind of driven growth on the platform. And coming back to the last 90 days, it has been very, very interesting because last year on the platform we did about 55 transactions. And this year we actually had set a goal of saying that we should at least touch 100 transactions this year. And the first 3 months we did about 26 deals, right? So we did about 10 in January, we did about 6 in the next month, and then March we did 12. April and May the transactions had slowed down, so we kind of did about less than 10. But June was very interesting because we did again 9 transactions in June, right? And just to kind of come back to how we are seeing the platform in the last 90 days, what we did as a team when we started seeing this lockdown starting to happen and the market starting to slow down, we reached out to about 600 to 700 investors on the platform just to understand what would be the sentiment on investing for the next 3 months and how should we prepare ourselves and the team for the investing space. And very interestingly, about 40% of investors came back and said, I'm going to continue to invest, right? Because if you look at early stage investing and if you look at private markets, typically if you're an angel investor, you will know that you're not investing to get an exit in the next 3 to 6 months, right? And you are looking at a much longer horizon. So you are looking at patient capital. You are looking at people who are looking at exits about 5 to 8 years. and they said it is okay because I have kept aside this allocation for investing into startups. But how they evaluate startups and how large checks they write, that changed. So that is what was the kind of shift we saw when we started to look at early stage. So people started to write smaller checks. So where they would have written probably a $50,000 to $60,000 check, they started to write a $25,000 to $30,000 check. So the check sizes became smaller, as well as the way they were evaluating founders changed. And very interestingly, what we did not see a very dramatic shift in valuation, because in my mind, in the last 1 year, people have been talking about the winter is coming in private markets, so valuation had started to correct in early stage. And what we saw in the last 3 to 4 months is about a 10 to 15% kind of downward shift in valuation, but not dramatically, like not like at a 40-50% discount. Right, so that was the other kind of point. And like what you'd already mentioned in your earlier webinar, this is actually about flight quality, right? So really, I think a lot more stringent in terms of how you would evaluate a founder. So this is more difficult. So today's market, you cannot get away with a lot of projections and lot of not understanding, a lot of a high level detail will not work. Right? As a founder, you really need to understand the details of your market. How are you going to look at the next 12 to 24 months? Because capital is going to become difficult to raise. A follow-on round is going to become difficult to raise. So I think those are the kind of smaller shifts we have started to see. But again, very encouraged because the last 15 to 20 days, we are seeing the market rebound back in terms of just the transactions happening in the market. And I believe that this will kind of go back to about maybe 60 to 70%, may not go back to 100% of what we saw in January, but will go back to about 60 to 70%.
That's great, Shanti. So that's very encouraging to hear that there were 9 investments that closed in on LetsVenture just in June, right? And to see the sort of the rapid pickup from April through June. And also, I'm encouraged to hear that valuations haven't. So what you're saying is valuations had already corrected before COVID, so there hasn't been a significant further downward change in valuation. And as you said, obviously now you have to be totally buttoned up, when you're going to fundraise. So thank you for that.
So there are 2 points, just to kind of add one more point, because the founders today, founding companies are really strong, right? I think they are not willing to go down a lot on valuation because they understand how they are building the company. So the quality of founders also has gone up. I think this is the first time in my last 6 years have I seen founders start with the deck saying, how am I going to overcome the crisis, right? I mean, you would never see a slide from a founder saying how is my business going to address a downturn. Typically that slide is never there, right? But today, if you look at founders, the first opening statement is about how am I going to tide over the next 12 to 18 months, right? And that is why we are seeing much better founders, better thought through processes, thought through businesses emerging, where they are not willing to really go down on valuation as much.
Got it. Terrific. Thank you, Shanti. By the way, I'm so sorry. I was told that the connection was a bit patchy. So I have moved to a different room, which is why you see a different background. And hopefully the connection will be a little better. But in case it's not good, please write to Airtel. Because I think you should let the Airtel team know that connectivity is a challenge. No, I'm just kidding. I'm a big fan of Airtel as a brand. Okay, Alok, let's move to you. So Alok, you're a very active angel investor. You're co-founder of the Indian Angel Network. You've formerly been, you were a venture capitalist for a decade. So tell us a little bit about IAN. Hopefully everybody on the call is familiar with Indian Angel Network, but tell us a little bit about the Indian Angel Network, as well as your own angel investing activities. And much like Shanti said, maybe you can also give some color and context of what are you seeing, let's say in the last 30, 60 days in terms of both deal activity, what kind of founders are able to raise, etc. So over to you.
Sure. Thanks, Rajan. So Indian Angel Network, as Rajan, you mentioned, is the largest angel network globally. We set this up about 15 years back. We now have close to 500 members. These members are people who want to make angel investments, but more importantly, engage with the process of startup formation. So the whole thesis behind setting up Indian Angel Network has been to bring in capital, but with that bring in mentoring and industry advice. And since none of us as angel investors have knowledge in all the different industries, in some sense through the network we rely on each other to be able to guide us in areas where we might be deficient. So if there is a company in the online media space, then we have a few of our members who understand that really well, and they might lead the charge on that investment. And if there's something that comes up in consumer goods, we've got members who have built businesses in that space as well. So as much as this helps us as a network understand opportunities better and hopefully make the right investments, it also helps entrepreneurs leverage the part of the network to make sure they can get industry-specific advice and guidance as they build their businesses. IN has done about 170 investments over the years. I personally invest through IN. I invest outside of it. I have a portfolio of about 60 companies, which is a fraction of what Rajan does, but still. This year, actually started out very strong. So for me personally, this last 6 months has been the most prolific. I have made 10 individual investments in the last 6 months alone. But I must say that a lot of it was committed before the lockdown started, right? So after the lockdown has happened, it has been harder to meet entrepreneurs, hence be able to look them in the eye and understand what is it that they're exactly planning to build. And hence the momentum has slowed down for me personally. At IN also, we normally make about 10 to 12 investments every quarter. Last quarter, we've made 4 investments. So there is a slowdown in the pace of investments. I think qualitatively, things that are continuing to do well in the lockdown scenario are things that are attracting more interest. So while I agree that most of us invest for a long period of time, and a 3-month or a 6-month slowdown should not affect our view on a particular opportunity, but realistically, what happens is that the numbers and the metrics that the company is showing suddenly get thrown totally off, where it's impossible to interpret them. Right? Imagine having built a company to demonstrate 100 customers acquired per month, and the whole unit cost model breaks down if that same engine is being used to acquire 15. So it's not that the conviction that this is a large opportunity going forward is not clear, but it's just harder to look through the metrics to understand whether what has been done so far is working or not. So the kind of businesses that we've been able to invest in, EdTech has clearly been an area. So a couple of investments have happened in that space from the ones that I mentioned. Financial services, fintech continues to be an area of interest. Many of these founders are still in their product build cycle. They haven't launched. So while financial services in many spaces has been hit hard because of the COVID crisis, since these companies are not yet in operations phase, they're really kind of putting their blinkers on and focusing on product development. So those are the kind of spaces where we are seeing continued activity. I agree with Shanti, haven't seen a downward pressure on valuations. And I've seen this in the previous down cycles as well. Very often, the reaction of investors to down cycles is to elevate the bar rather than to try to suppress the valuation, especially in early stages, where valuation is very much a mechanism to make sure that all parties are incentivized going forward. The idea is not to extract the maximum ownership out of the company. And so that is something that I'm again seeing, in the last 3 or 4 months. Credible founding teams are managing to attract investors at valuations which are similar to what they would have done otherwise. But it is harder to convince investors that the data and the metrics that are being showcased are robust enough to take a call on.
Great, thank you, Alok. Let's now get in. Maybe we'd like to double click on a couple of these areas, right? Maybe we'll start with, what range of capital. We had shared in our part 1 of the series, Shanti and Alok. One way to think about, if you want to raise, let's say 10, 20, 30 lakhs, maybe friends and family is the best way to go. If you want to raise between 50 lakhs and 2 crores, you can go to, let's say, a group of angels. and then angel networks, and go to online platforms like LetsVenture, and then you have seed funds and venture funds and so on, all tied to sort of the seed. If you sort of define a seed round as maybe 10 or 20 lakhs all the way up to 15 crores, who can you go to at different levels, quantums of funding that you're seeking, right? Can each of you maybe talk a little bit about, and maybe again, Shanti, you can start, like what is the average that a startup is able to raise on LetsVenture, and what is the range, right? So for instance, when should they come to LetsVenture if they want to raise what amount, and when does it not make sense, right? And then maybe also talk a little bit about how long does it take, and what's the process, just not too detailed, but like, is it like, is it a couple of weeks? Is it a couple of months? But start with what's the amount, because, I think a lot of us, founders who are watching this will have this question of where should I go depending on, how much I need to raise.
Yeah. So I think our LetsVenture sweet spot, just to answer that question, Rajan, the sweet spot is somewhere between 1 crore to about 3 crores. Right. And that is, so if you're looking to raise like a angel round, not your first check. So a marketplace typically will not work for a first check, because it is my also belief that, if you're not able to get that first 20 to 30 lakhs within your own circle, who actually know you a lot better, right? Who kind of have seen you evolve the business. So friends and family is actually the right place to kind of raise that first 20 to 30 lakh check. And we typically see founders put in their own capital, because again, the last 2 years, very interestingly, the profile of founders coming up are typically people who have already worked for about 5 to 8 years, right? So they've kind of saved up some capital, which they are willing to put into their venture when they start their funding. So basically on LetsVenture, the sweet spot is somewhere from 1 to 3 crores. And the way the process works is that, and this is for early stage. So this is for the early stage platform. Like I said, we also have a growth stage platform, where we are looking at anything from 5 crores to 20 crores, right? And that is for a growth stage company, which is a post Series A, Series B company, where we typically bring in family offices who would co-invest with a large institutional investor. So I'm kind of keeping that conversation outside the scope of this discussion, because here we are talking about early stage founders. And the way the process works is that the founder would come and create a profile on the platform. So the platform is free for all founders, but the profile is not open to all investors, right? So you are free to come and create your profile, and you can specify whether you want to keep the profile in stealth mode or you want to open it up to all investors on the platform. So typically we encourage consumer companies, or companies who want a lot more reach to investors, to kind of keep it open, because if that investor doesn't become your investor, he at least becomes your customer, because a lot more people know about your product. But the option lies with the founder to keep the profile in stealth. So once the profile is created on the platform, we have a small team which curates the profile, and we curate it not from fundability perspective, because I believe that, just like Alok said, I think we cannot represent the thesis of my 7,000 investors on my platform. But what I can do is I can take away things I know where the information is not complete, or I know is not going to get funded, just from the intelligence we have built over the last 6 years of working with companies. So we know which sectors are not going to get funded, or what traction is needed for you to start talking to investors. Because, my belief is also, you should not go fundraising just because you started a company, right? You should go fundraising at the right point of time, because fundraising can take away a lot of time and energy from the founder if you're not at the right point in your venture for fundraising, right? So we kind of try to encourage founders to come back maybe after 3 to 6 months if we think that timing wise they are not right to start fundraising. That is the second process. The third process is, we have a process where we put it in trending or featured. So when we put it in trending, it goes out to all investors who have signed up for that sector. It goes out on our mobile app, and investors start to look at the profile, start to engage, some of them start to commit. And based on the investor engagement with the startup profile, it starts to move up in trending. And if we get enough interest, then we actually feature the deal. And when we feature the deal, there is a deal manager who then gets assigned to the founder. And then we work very closely with the founders to reach out to investors. And we also work with about 120 micro funds today on the platform. So what we do is the moment the startup goes into trending, it also is sent out to all the micro funds. And a lot of time that becomes very, very valuable to the founder, because a lot of micro funds either will say, this is interesting, I want to talk to the founder, or ask him to come back to me after 3 months, or this is not something we are going to be investing in. Right? So those are very quick references for the founder. And as a platform, we are a marketplace. So we are not a market participant, right? We are a market enabler. I think that is the very clear distinction we make. So we don't ourselves invest, which keeps away all the conflict for me and my team when we work with founders, right? So when the startup gets featured and when you get assigned a deal manager, the typically from featured to money in the bank, it's about 4 to 6 weeks. And usually we see the delay on the side of the founder. Very interestingly, Rajan, it is usually never on the side of the investor, right? Because founders are not ready with due diligence information. They're not ready with their financial information. And my team sometimes spends a lot of time just following up with them to get all the information in order for us to do the due diligence. Because as a platform, once we get commitment from investors, we also do the entire process of due diligence, financial due diligence, legal due diligence, all of that. And unless the lead investor does not sign off on the due diligence, we don't do call for money. And a lot of time we have seen, at least in 50% of my cases, right, the transaction is delayed because the founder is not ready with all the information required for the investors to do due diligence, right? But it is it is actually a very similar process to how an offline network would work in the initial phases, right? Because we have not changed the way angel investing fundamentally works, right? What we have created with LetsVenture is to create more efficiency and transparency, right? So, and the fundamentals of angel investing doesn't change, because you still need a lead investor. You still need an investor who will represent the rest of the investors. So all of those basics of investment don't change. So typically a founder, if he already has a lead investor, it is very quick, right? So then sometimes we kind of close commitments in like 36 hours. We have raised about 2 crores. And it really depends on who is the lead investor who is leading the round. Because a lot of times, if you look at the investor behavior, there is also a behavior of faith or trust in the person who's leading the round. So the lead investor becomes as important as the founder in that transaction. And if you get a very strong lead investor, right, who already has done a lot of investment, who understands the space, who's got good exit history, right, then we are able to syndicate the deals like in typically about 24 to 48 hours. We're able to do about 1 to 2 crores on the platform very easily. There are cases when the startup does not have a lead investor. Then we have to reach out to all our lead investors. We have to reach out to all the micro funds. We have to actually do the work on behalf of the founder. And that initial phase could take about 4 weeks. So it really depends on, what is the stage of funding you are in, where are you in terms of traction, and, how much are you trying to raise. In the last 3 months, we have seen this round sizes have become much smaller. Right? So because people are also today becoming a lot more smarter about how they want to build companies, right? So where a startup would have said, I want 1 million, today I'm clearly seeing that come down by at least about 50%. They say we're okay with doing 2.5 to 3 crores because we want to kind of build the company during this downturn.
Got it. Thank you, Shanti. That's very helpful. So sounds like if you're raising 1 to 3 crores, right? LetsVenture is a platform that you can go to, and then depending on your readiness, whether a lead investor quickly sort of wants to, invest in you, it could take anywhere from 6 weeks to maybe 8, 12 weeks, right? Depending on the it sounds like 6 to 8 weeks maybe is the thing. And by the way, on this point that Shanti made, which is a lot of times once an investor decides to invest, it takes much longer because you're not ready next week. If you're actually in the process of raising, or you plan to raise in the next 3 or 4 months, please do join our webinar next week, because actually that is focused on what happens post-term sheet, right? And we actually have Sequoia's, 2 of our leaders from Sequoia's finance and legal teams are going to come and talk about term sheets, what should be in it, what should not be in it, and most importantly, how do you prepare so that you can go from there to actually getting the funds in the bank. Okay, now let's move to Alok. Alok, can you talk a little bit about the similar question for both Indian Angel Network as well as when you're investing either by yourself or with a couple of other angels, right? What is the round size, and also how much time does it take, and anything else that founders should know if they approach, let's say, Indian Angel Network?
Sure, sure. So, Indian Angel Network operates in two different buckets of investment. The first one, which is the dominant activity in the network, is a check size of under 6 crores. More typical 1 to 4 crores, but anything under 6 crores is what we call the network deal. The entrepreneur essentially in this case submits the proposal to our team. Our team does the basic screening, if possible, guides the entrepreneurs towards any changes that need to get made, any information that needs to get added to the pitch. And after that, we have sessions in most of the large cities where about 10 to 15 angel investors are physically present, in COVID times, virtually present. And the founder gets to pitch in person to those angel investors. Right. The purpose of this pitch is essentially to find the lead. Right. So even in the IN system, the identification of a lead investor is a critical point. However, we realize that many of the entrepreneurs may not have access to the leads themselves. And hence, we have created this forum as a forum where, in a face-to-face pitch scenario, the entrepreneurs can get access to 10 to 15 investors. And if they are able to convince one of them to be the lead, then the process moves forward. Typically, after this, the leads will do some due diligence at their end to make sure that the opportunity is real. They buy into how large the business can become, whether it's a good investment opportunity. And once they're ready with that, the deal is circulated to rest of the network. Right. This is to invite other angel investors to join the syndicate. Typically, it's a 24-hour closed-ended subscription process. And most of the deals that have a lead attached to them do get subscribed. So essentially, if in the first meeting you are able to get a lead and then through that process of initial diligence, retain that lead, then the certainty in the process is very, very high. The end-to-end cycle time is about 60 days to get the money in the bank. About half of that is in getting the whole investor group together. The rest half is in getting the documentation done and wiring the money to the company. The second bucket that Indian Angel Network plays in is through the IN fund. And any business proposals that we get which are seeking to raise more than 6 crores are handled by the fund. So there is more, institution-like diligence done by the fund team itself. We also get individual angel investors to participate in that because many times they can be the source of value addition that we spoke about earlier. The process duration may end up being 3 months instead of 2 months because these companies would typically have a certain degree of operations. They will have more to diligence than a company that is trying to raise a couple of crores of startup capital. In the angel category, I think the process is very similar. It is a bit more disorganized in the sense that there is no systematic mechanism to identify a lead. Right. So deals come from all over the place. People might write into the email ID. I'll get a bunch of LinkedIn pings, and really the first decision is whether to spend time on this or not. Right, which is literally a 2-minute decision of does the elevator pitch sound interesting enough to seek this. Right. So just to give you a sense of numbers, I'm not very outbound in my angel investments, but I would get maybe about 50 expressions of interest from founders every month. And maybe there'll be 1 or 2 of those, right, that I would want to learn more about, right? And that is just my constraint on bandwidth and how much time I can spend doing this. The next step is typically then getting the full pitch deck, talking to the entrepreneur. I'd normally, again, in interest of efficiency, whether it is COVID or non-COVID, that first interaction ends up being on the phone, right? And that gives you enough to say, is this interesting enough to lead or not, right? And if it is interesting enough for me to lead, then I've got a set of people who I normally, invest with. I'll send the deal out to them, tell them I'm doing this. Are you guys interested? Normally, they will commit fairly quickly. So the path to commitment here will be maybe slightly shorter actually, because the syndication process is very quick. And we might get done in 2 to 3 weeks with the syndication, another 3 to 4 weeks to close, right? However, the certainty is lower because most people who are doing this, like myself, are allocating very small part of our time doing this. There is no team behind it to really make sure that every proposal is getting the deserved attention. On the inbound side, just in a reciprocal manner, sometimes I might get a deal from one of my friends saying, "I'm doing this. Are you in?" And there, really, I'm investing behind the friend, not behind the company, right? Because I then trust that person to have done what they need to do. And unless it's something that I'm conflicted with, normally I will go and say, "Sure, why not?" Right? So there are both of those kinds of scenarios that play out. But timelines, again, 6 to 8 weeks is very typical. I think the hard part about angel investing from an entrepreneur standpoint is not what the process looks like when it's running smoothly. Right? The hard part is what it looks like when it's not running smoothly, right? Which is you're not finding a lead for 2 months and you're still on the lookout for the lead investor. And I think that is where the ability to pick feedback, get that 5 minutes, use that 5 minutes not just to convince the other person, but also to listen to what the feedback is. Does that require you to fine-tune your presentation? I think those elements become extremely important in successfully navigating the downside scenarios.
Got it. Terrific. Thank you. Thank you, Alok. So it sounds like 1 to 6 crores is sort of IN, takes about 8 weeks if all goes well. And obviously all, invest across sectors and angel investors can be, as long as it takes to get the right lead angel, and then, that lead angel then will hopefully also help you, corral up the others. So how does one, if you get 50 pitchers a month and you decide to meet only with a few, let's say one of the founders, and I'm using you, Alok, as an example of a very active angel investor, how does one make sure that Alok Mittal reads their email and pitch? What's the way to do it? Is it what they say in the email? Is it getting referred? Is it doing, showing up at your doorstep? Hopefully don't do that, please.
No, so showing up at the doorstep is not the answer, right?
Especially during COVID.
So actually, I once had an entrepreneur show up at the doorstep. And, having been an entrepreneur, I'm very empathetic to those scenarios. But the only signal that went up in my head is if I meet this person, then the word is out that you can land up at the doorstep. So that is not the incentive system.
So how does one make sure that you're going to read their pitch?
Yeah, so I think there are 2 or 3 things, some that entrepreneurs can control and some that they can't, right? I think the clarity of what you're building is extremely important in that first elevator pitch, right? So rather than talking about the fact that, social media is broken, you can get spammed on social media, right? That story is too long, right? If entrepreneurs can be precise about, hey, I think I'm building an operational optimization tool for Indian manufacturers, right? Now, I get that story. Now, the second part is I might be interested in that story or not, which is hard to control because most angel investors don't articulate really what they're interested in and what they're not, right? You want to let the flow come in and then decide rather than, so you will not find, what kind of a deal will be interesting to me in the next 3 months because I haven't thought about it, right? I listen to a story. If I like it, I jump on it. If I don't, I don't. But I think what entrepreneurs can control is how sharp their message is, about what they're building. And if they can outline anything which inspires more credibility in the founding team itself, right? So if you've got 30 seconds, my request would be to focus on those 2 elements. What are you building? And then I'll make the decision on whether it excites me or not. And 2, who are you? And why should you be the person who's building it, right? So if you can condense that message, I think that is what gets me to move. If there is a reference, even if it is not a lead investor reference, right, then it helps because that is one way to filter quality. If you know someone who I know and they are saying, "Hey, great guy, talk to him," right, then certainly that person will get a phone call back. So I think those are the things that really sit at the first gate for me.
Got it. Terrific. Thank you, Alok. Okay, let's now get into a couple of topics and go through them quickly, right? So maybe first start with I want to build on what you just said, Alok, which is what makes a compelling pitch. So last week, on Saturday, same time, we had an entire session focused on making the perfect pitch. But as far as you're concerned, whether it's you as an angel or when you're looking at an IAN investment, what is a perfect pitch, and what are the mistakes founders make? Because sometimes pitches just don't go well, right? What should they avoid? So what should they do? You hit on two of them. If you had only 30 seconds, but let's say you have a 30-minute pitch with IAN or with Alok Mittal, what should be in there, and what should they avoid, or what should they watch out for?
Yeah. So I think there is the content and there is the storytelling of the pitch, right? From a content standpoint, I think the 3 or 4 core elements is, why is this an interesting problem to solve? Right. So is the problem real? Is the market large enough? Right. Second is, why is this the right team to solve it? Right. So where is the team deriving its inspiration, passion, skills to go after this problem? And how the problem is proposed to be solved, right? Where value actually accrues back to the company. So whether it is about defensibility, whether that's about the business model, right? So I think those are the things that I normally look for in a pitch. Then there is the storytelling element of the pitch. And I think that is a hard one because I've seen pitches that go horribly wrong because they are just full of storytelling, right? And it becomes very hard to read what is actually going on. And there are pitches that can be very, very drab, right? Because they go on a template of, and this is the market size, and this is my customer persona, right? It's almost like a classroom that I teach. So I think the right amount of storytelling is important. But ultimately, see, like any other sales process, this is a sales process. Entrepreneurs must remember that they are not putting an information memorandum out, right? I'm not interested in knowing how social media functions. I'm only there to make one decision, which is whether I need to invest in this company or not. And honestly, the entrepreneur is not there to educate me on social media. They are there to get my check, right? So I think as much as entrepreneurs can deal with this like a pure sales process, it helps both the entrepreneurs and the investor. What does it entail? Every slide must have a reason to be there in the pitch. And I think there are only 1 or 2 reasons for the slide to be in the pitch. And I would claim the first one is only answering the credibility question. For me, even the market slide is a credibility question. Do you really understand what the market is? And I don't want to look at this as a $50 billion market, right? Do you understand the market at an insight level, right? If you do, then I know that I can give you a +1 on your credibility, right? And credibility not meaning, this is not IIT, IIM years of work X. This is credibility as an entrepreneur who has gone out, understood the market well enough to be able to come in and place those 2 insights that are relevant, right? If you're talking about competition, right? Are you talking about your competition in a manner that is insightful, right? Or is this feature comparison chart, out there for everyone to look at and interpret on its own, right? Now, again, why is that important to me? That's important to me because I can see whether the entrepreneur has invested time, effort in learning and understanding what the real gaps are, what the competitive advantage of this company can be, right? So if a slide is not selling the credibility of the team to address this opportunity, I would very much debate why that slide should be on the pitch deck.
Got it. That's very, very helpful, Alok. Shanti, let's move to you. You guys see thousands of, I don't know how many business plans or pitchers come to LetsVenture every year, Shanti. I mean, if you do 50 investments, there must be thousands.
300 to 400 a month.
How many?
300 to 400 a month.
Okay, 300 to 400 a month. Wow. So that's amazing. So you have 5,000, you could get up to 5,000 pitchers or business plans a year, right? So it's the same question to you, Shanti, as you look at LetsVenture, what makes angel investors or investors on the platform get very excited about a pitch? And by the way, it could have nothing to do with the pitch. It may just be how they deliver it to Alok's point. Is the deck important? And also what should be in the deck, and where do you see it going horribly wrong? Where, wow, that was a great idea. They had great traction, but man, they never were able to raise. Why is that? So to give us some color about, so founders on the call get a good sense of that.
Yes, so I would kind of build on what Alok said, right? So completely agree on all of that. I think one of the main kind of points I see in very early stage founders is don't have someone else create your deck, right? You have to make your own deck. I think the moment you are not able to articulate your story through your own self, right? And sometimes the deck is not about the presentation, right? It is about how you have thought through the flow of the slides. And are you able to bring out why? Because I believe angel investors, if you don't get their attention in the first 30 seconds, you've lost them, right? And I think the first slide has to be about why. Why are you doing this? What and what is? Are you able to articulate your entire venture really precisely? And I think that requires a lot of effort, Rajan. I mean, I have personally seen that when we have created our own Let's Venture slides when we went fundraising, right? It takes about a month to get your fundraise, the first slide right. Because the first slide is when you either get the investor or you lose the investor, right? And that entrepreneur's ability to actually go and really pick out what exactly is he solving for, and what is the big picture there. If you're able to articulate that, that is the first most important thing. And second, I think a lot of founders make a mistake when they put the team slide right at the end, right? I think your second slide has to be the team slide, because a lot of times it is about when the moment I hear the team, I know whether this team can execute this vision or not, right? Somewhere in the back of my mind, and good or bad, we all have our own biases towards people, right? I don't think, like, even if an investor says I don't want to be biased, I think we carry our context with us, right? And we carry the context of a lot of things we have done in the past, and we always apply it when we look at something new. And when we are looking at a new pitch deck, or when we are looking at an entrepreneur pitch to us, I think that second slide on team credibility is very, very important, right? Why do you think you are the team which is going to solve this problem? And why is this team going to win? Because at the end of the day, we all know startups are about execution, right? And it is about you being able to articulate that. So deep thinking, I think a lot of founders, at least personally, whom I have invested in, when I get excited is when you actually realize that they actually think very deep, and they are able to answer any question you have about the problem they're trying to solve, because they know why they are building this venture. And I think over the last, about not in the last 2 years, but before that, I saw a lot of founders starting up because they wanted to raise funding, because they could be in the news, for all the wrong reasons, right? And that kind of comes out when you start kind of listening to the entrepreneur. The third, I think, is, though communication is important, like the way you present your pitch is important, I think communication is overrated. Because I actually think I have seen founders who are not very good at communication, but you listen to them carefully for about 5 minutes. And a very good founder, you are actually enchanted by his entire way of how he is thinking through the problem, right? So what I want to say here is, it is okay not to know very good English sometimes, right? Not to be able to have the right just the words. But if you are genuine and if you are passionate about what you're building, your words will show through that. I think you have to be true to why you are being an entrepreneur, and I think the pitch brings that out there. And the places where people have not been able to raise funding on the platform, just to kind of come to that, where things have failed, is typically when it is already a very, very invested market, right? It is very, very competitive, and you come and say, you know what, I'm going to build the next Facebook for the world. They're like, okay, you know what? While it is very good to be unapologetically ambitious when you're an entrepreneur, I think you have to also be a little real, right? Because no investor is going to go write a check for you to create a new social network which is going to take on Facebook in the world, because I think it is beyond just features and user credibility. So I think not able to, even articulate why is that, why are you, and why are you trying to build that? That is the first. And we have seen few kind of deals just fall off the platform, right? And those are cases where, again, it is a very crowded market. There's a lot of funding already gone in, or in the last 2 months, the way I have bucketed the kind of deals is that there is one which is where the behavior has changed during lockdown, and one where the behavior will permanently change after COVID, right? And I think you have to learn to differentiate between those two. I think people are using too much of COVID and too much of online presence into everything, and without knowing whether this is actually going to be something relevant post lockdown, like post life is going to get back to normal eventually, and will this behavior continue to sustain as a user behavior?
Great, thank you, Shanti. I wanted to just, Shanti and Alok mentioned a few things, several things that I wanted to build on a little bit. First of all, by the way, if you didn't go to part 1 and part 2 of the series, please do go, because both Alok and Shanti talked about a concept that we talked about called founder market fit. Sometimes it's called by founder product fit. It gets to the heart of this question of why is this founding, what does this founding team have? What is their right to win in this market, right? What set of capabilities do they bring to the table? What set of insights do they bring to the table? Do they show the kinds of sort of both domain expertise, functional expertise, and also sort of perseverance and the other softer skills that are required to win? So actually, we spend a lot of time on this notion of founder market or founder product fit. We talk a lot about product market fit, but actually the founder market fit at the seed stage is even more important, right? And that's something that angel investors, investment networks, seed funds. So for instance, at Surge, it is the single most important thing we look at is the capabilities of the founding team, and asking this question of, can this team really go build this business? A couple of other things that you guys mentioned, I think making sure that not only do you write the slides, but you actually present it. I must tell you, a month ago, I showed up to a pitch meeting at Surge, and a financial advisor was making the pitch and the founders weren't there. Guys, that is like the absolute cardinal mistake. The absolute cardinal mistake. If you're going to go raise money, you should be raising the money, right? Please, so you can get like your friend who sort of got another startup who's raised funding, get their help and get others help to create your pitch deck. And today, there's a lot of online material you can go watch about what should be in your pitch deck, but please don't have others go make the pitch for you, right? So that meeting actually didn't go well at all. Quite frankly, even if the idea was interesting, so please don't do that. And then a couple of other things that I think both of you mentioned, being able to succinctly describe what is the problem you're trying to solve and what is the product. Sometimes I find that I'm 10 minutes into a pitch and I have no idea what this set of founders are trying to build. Guys, that's not a good thing, and the only reason we're still listening 10 minutes in is because we're polite, right? But so keep in mind, to Shanti's point and to Alok's point, in the first 1 minute, maybe it's not 10 or 20 seconds, but at least in the first 1 or 2 minutes, the investors have to clearly understand what you're trying to build, right? And so I think those become very important. Okay, let's go to the next, maybe double click a little bit on this. So would you guys, let's say, IAN, Alok, you as an angel on LetsVenture, if you're a pre-launch company, can you get funded either on LetsVenture or on IAN, or maybe Alok as an angel? And then I'll talk a little bit about Surge as well.
Yeah,
I don't know.
So,
Maybe.
I've seen more of that happen with individual angel investors. As soon as you get into somewhat more organized framework like IAN, there is an expectation that the entrepreneur has taken the first few steps themselves, and hence will have something to talk about by way of actual experience in the market. It doesn't need to be revenues. It might be pilot customers. It might be just, if it's a consumer app, it might just be downloads and retention. But yeah, on the individual side, I've seen several angel investors back teams, right out of the gate. The amount might be smaller, so I've been part of rounds which are 50 lakh, 60 lakh rupee rounds, just to get the, idea started. So yeah, very much not just pre-launch, pre-incorporation funding is something that we've done, in individual networks.
Got it, Shanti?
Yeah, for us, it depends on the sector. So if it's a very deep technology company, right, then pre-launch is okay, right? Because they are kind of raising the money to build out the patents and to file patents and to build the defensibility around the product. And that could actually work on LetsVenture. Again, coming back to Alok's point, I think what LetsVenture marketplace does, it actually reflects what individual angel investors would behave, right? and we actually have individual angel investors who found a founder and who come and use our fund. So we have an angel AIF fund, right, which is a vehicle which allows only one invest into the company, and we are seeing a lot of that come today. Where if I have a group of about 7 people who I co-invest together, and I found a founder, I actually come to LetsVenture, and then we all 7 put in the money, and then we raise an additional smaller check on the platform, or we would just use the vehicle to invest into the company. So basically, depends on the sector. If it is a technology company, then pre-revenue is okay. If it's a consumer company, typically pre-launch is not good because people are very, very doubtful about consumer behavior. So you still want to see a pilot. You still want to see how have consumers reacted to that product, right? How much love, like what you talked about, Rajan, what is the customer love being shown to that product? I think people want to see that validation. If it's a SaaS company, then of course, today people don't want to see free pilots being done. They want to see whether the customer is willing to pay. So have you been able to do a paid pilot where you're able to discover the price of the product? I think those are the kind of factors which come in when you come to the platform.
Actually, I think with individual angels, you can also appeal to their need to see the answer.
Yes.
Right. So I've seen, many times entrepreneurs come in and they're tabling a very interesting problem. They haven't built anything. And I'm almost saying, we need to figure out what happens.
Yes.
Right. So if you can inspire that, in that storytelling, where I can't walk away from the story till I know the end to that story. Small amount of money, 20, 50 lakhs can be put down to say, okay, let's at least, turn the page and see what's next. In institutional paradigms, that becomes harder to do. Because you are trying to then create a syndicate, convince other people. But smaller checks with individuals can often be just on basis of shared curiosity.
And I think, sorry, go ahead, Shanti.
Yes. So it also depends on the founder profile. So if you're a serial entrepreneur, you, like Alok said, right? You don't even need anything, right? You just need to talk about the idea. And I think people look at your track record and they know you, right? And a lot of people understand that your ability to raise the next round because of your persona is going to just push you through the entire process. I think people will just take a bet on you. So a lot of times I've seen for serial entrepreneurs on our platform, they are not completely convinced of what is happening, but they are putting in the check because they know about the founder's ability to go and raise his next round. He just needs to get over the first bump. So that,
yeah, I think just to build on that, at Surge, and also we see this with other seed funds like, very early stage funds, right? So Surge, basically we invest $1 to $2 million upfront as soon as we select a company or partner with a company, and then they start the program when the program starts. But in our second cohort, which is our last cohort, we're currently in our third cohort, we had 20 companies. 6 of them were pre-launch when we partnered with them, right? So we invested $1 to $2 million in 6 out of 20 pre-launch companies. And to the point that both of you made, the bet that we really made was on the founder market fit. So I'll give you an example. It's not an India example, but a company called Chili Belly, which is actually, it's an Indonesian fresh social commerce company, right? The 3 co-founders, they were all, 2 of them were ex-Lazada, one of them had been ex-Lazada Alibaba, one of them had actually built an e-commerce company before. All 3 of them knew Indonesia deeply. And Indonesia is a very social market. So at some point, they actually had studied the PDD model, Pinduoduo model in China extensively. And they actually left Lazada, I think in May or June. They incorporated the company in July, and we partnered with them end of July, right? So, and then they actually launched only in September. And if you that's an example of founder market fit, because you didn't have to go and teach them about they knew everything there was to know about e-commerce, about logistics, about merchandising, about unit economics, about supply chains, about all of that. And obviously they had to go prove a thesis because nobody had done social commerce in Indonesia the way they're doing it today, right? In any category. And so that was a bet we had to make, saying, okay, this is a team that's good enough and has deep enough domain expertise that they can actually go build a new model, a social-driven sort of fresh commerce model, and we had 6 companies like that, but they were really bets on deep bets, on founder market fit, right? And I think so at Surge, for instance, we say we believe that, it's never to apply to search, right? You can apply before you launch, but if you're applying before you've launched, you just need to make sure that this question about the founding team's right to win is crystal clear. And then when we meet you, your insights also have to be that deep about the market that you're trying to solve. I have one more question before we open it up for, we have lots of questions that have come up. Payal is going to get up here and ask a whole bunch of them. So let's say that they've launched, right? What are the most important metrics, right? And I know it's hard to say because, you could be a consumer internet company, online, offline company, B2B company, SaaS company, B2B e-commerce, etc. But what are the most important metrics, Alok, maybe we'll start with you, that you look at to give you early signs, as you said, right? It's about the founding team, it's about the story, the product, etc. But if they've launched, are you even looking at metrics as an angel? If they've launched and they have metrics?
So I think if the company has launched, then certainly yes.
What kind of metrics do you look at?
Yeah, as you mentioned, metrics vary by the business, but really at that stage, what you are looking for, is the product, does the product seem to be working or not? Right. This can, in an enterprise company, it can mean, if they knock on 20 doors, how many people invite them for a second meeting? For a consumer company, it can mean, what is their M30 retention, right? I typically, I'm not so driven by the number of customers and so on, right? Because there are ways to acquire those customers. I'm really looking for, does the product seems to stick or not, or in the enterprise context, the value prop resonating or not. But I think the second piece is, I do believe that startups must prioritize their biggest questions first. So if the sales channel is an issue, right, then founders must answer the question of sales channel as early as possible. Right, this is along the lines of fail fast, don't postpone your most critical pieces. So that is the second line of metrics that I'm interested in, of saying, okay, was there a product risk here? If so, does the product seem to have gone over the bar? Was there a team building risk here? Right, in many of these there can be a very deep team issue. Was there a sales channel issue? So depending on what in my view is the big uncertainty, I would want to start to wrap my arms around saying this looks better than what I thought.
Got it. That's very helpful, Alok. Shanti, what's the most important thing that you look at?
So here it depends on how much money the entrepreneur is trying to raise. If he's trying to raise about 1.5 crores, sometimes the metrics is important. Right, and if you've already launched it, but if you're trying to raise 6 crores, then the metric changes in terms of how you are looking at the metric, right? And what we do, Rajan, is a little different, right? Though we kind of build exactly, whatever Alok is saying, I would do plus to that, right? Because all of that is of course important. But what we also do is, since we work with a lot of micro funds and VCs, we also know what would be required for the company to kind of reach that metric eventually, because whether we like it or not, once you've raised angel investing, you have to kind of go and raise the next round and the next round, right? Because that is the way the investors are also going to get their exit. So we also try to work backwards and say, for you, like a SaaS company, for you to raise a Series A, you need to be at a 1 million ARR. So in angel stage, you should be at 100K, right? So you kind of work backwards on the numbers. Like for a consumer company, right, then you should have about, at least 30% of downloads. But then what is the cost of user acquisition, right? Are you going to use the entire money just to spend on ads and to acquire users, such that you have a rotating door effect where you're acquiring users and you're losing users, you're not focusing on retention, right? So I think it is still very generic to be able to answer very specifically till you don't look at the business, until you don't look at what is the cost of that user acquisition and how have you actually gone about user acquisition.
Yeah, I think that's a great. Yeah, thank you, Shanti. I think to both your points, look, if you already launched, make sure that you understand the most important 1 or 2 metrics your investors are going to look for, right? Look, for instance, at Surge, we only look for one thing, by the way. It's called user love. Right, and to Alok's point, I'll tell you, last week, right, we met 2 companies. One had 1 million downloads, but had, they were both consumer companies, right, consumer internet companies. One had 1 million downloads, and month one retention of 8%. The other one had 10,000 users and a month three retention of 30%. Which one do you think is more interesting to us? Certainly it's the latter one, right? Because it shows that, consumers are using the product and they're staying with the product. So that shows user love, right? So if you're building a consumer business, looking at retention, that's the thing that we work with our founders on, right? And by the way, the same thing applies if you're building a SaaS company. The first step is you have to go get some customers, but then you have to make sure your customers retain, right? So if you're building an SMB SaaS company and your monthly churn is 5%, you don't have user love, because 60% of your customers or your revenue is going to churn within 12 months, right? So I think the big message there is, if you've launched, make sure if you're going to go fundraise, you understand what is it that the investor you're approaching looks for, and it's usually going to be the kinds of things that Shanti, Alok, and I just talked about. Okay, with that, Payal has joined us. Payal, over to you to ask us questions from the audience.
Thank you so much, Rajan, and thanks, Alok and Shanti. This has been fantastic. Lots of questions coming in, so we'll be able to answer only a few in the interest of time. The first one is from Abhishek, who says, "Hi, Shanti, excellent insights. Can you tell us about a tool or process that can bring efficiency and speed up for due diligence in startups?"
Yeah, so that has been the question we ask ourselves every day, because I think even for us, a lot of times we have a lot of companies we want to kind of get to, we are not able to get because we've not done call for money on the previous companies, and we don't want to confuse our investors with more new transactions, right? Because we want to ensure that we are kind of going through the process. But here the tools and efficiencies, what we do is we give a checklist to the founders. For the documentation you should be ready with all the information you should be ready with when you go fundraising. And don't take this casually, right? Because I think it is important that you build good governance and good compliance into your businesses, because it is investor money. And, for no fault of yours, that money could go at risk if the company does not follow governance or does not follow compliance, or you might just spend inordinate amount of trying to fix it later on. Right. So from that perspective, that is one. Second is we have open sourced our term sheet, our SHA, our founders agreement, advisory agreement, everything is available for free download on LetsVenture. And this has been actually vetted by companies like Axel, by 314, Mohan, right? They've actually looked at it. We've made it very founder friendly, investor friendly. So you can actually go and download all those documents and you can kind of look at all the checklist. The third is, of course, we work with multiple legal partners and multiple DD partners, so because the final decision of whom you want to work with will actually be still with the lead investor and the founder. So from that perspective, we've kind of stayed away from strongly recommending any one person, because at the end of the day, we want it to be completely transparent and completely compliant to how founders would want to do their paperwork.
All right.
So it is about,
Thank you, Shanti.
Yeah. So as a closing line, it is about keeping information ready on your business, right? Which basically means your audited financials, all your financials, compliance, the entire checklist. Just ensure that documentation is ready for the team to kind of pick up the moment you start seeing investor interest.
Yeah, and I think many of you may be very early companies that haven't been through even a first year of audit. But if you have launched, at least have your retention data.
Yes.
When we ask a founder, how about retention? And when there's a blank stare, meaning, what do you mean? That's when the meeting ends, by the way, right? So please make sure, again, retention, which is an indication of user love. Okay, Payal, next question.
Thank you. Next one's for both Shanti and Alok. Interesting one. Can you give us examples of pitches which have appealed to you personally, but eventually didn't get any investors, and vice versa?
So I can remember one right now. So this was a company, I must have seen it about 4 or 5 years back. A company that was trying to build a single identity for a person online, right? So a simple idea, a very compelling idea. Literally the number of passwords I have for different services is not funny. And so these guys wanted to create a single identity. However, I think the issue was that they weren't quite able to articulate how they're going to get this done, right? So the end state is very powerful, but how do you get from here to there was a key hole in the pitch. Fairly credible founding team. They understood the technology behind it very well. But because I couldn't, and I'm assuming that a lot of other people couldn't see the path for to get to that nirvana stage, that never raised money. So I think there is a little bit of a pattern on the kind of pitches where you're thinking about the end state, and the end state is compelling, it's exciting, but you can't figure out how to get from here to there. And for example, I see a bunch of pitches now, right, who will say that, okay, we are going to build this service, and once we have 5 million people on this, we will start lending to them. And I'm like, you build any service and you've got 5 million users on them, you're presuming success. After that, you can do a bunch of things with that, right? But I really want to know, how do you get from the initial state to that attractive end state? And that's a gap that I continue to find in pitches.
Yeah, so for me, Payal, I think I found a couple of founders where the idea was really interesting, but what kind of didn't make me probably kind of take that conversation forward personally. And I try to keep those personal biases completely out from the platform, because you want to allow the founder to be able to find the people he thinks he can kind of raise money from, right? But for me personally, it is about, when the founders are very, very, don't have trust with you, right? I think that is a deal breaker for me, right? He's not willing to share a lot of information, but he wants me to put the check into his company. And we're like, how am I even going to be able to work with you going forward? Because they feel, no, but you are seeing so many pitches and you have invested in similar companies. And if I tell you this idea, you're going to take it to the other founder. So if you start from the process of not being able to trust, or not being able to think that just talking about your idea is going to allow other people to copy your idea, I think it is already starting on a very wrong foot. So for me, that ability to just be open, just be confident about what you're trying to build, and assume that we also as investors follow the ethics of business, right? That I'm not going to take an idea from here and go pass it on to the next founder. I think that kind of somewhere it kind of becomes a deal breaker for me, because I don't enjoy those conversations after that, because both of us are very guarded, right? And founders whom I've typically invested in, I typically, when I invest because of what the board mandates me, I cannot talk about it to my platform investors. So typically when I commit to a startup, I don't allow it to be appearing on public on the platform. So that is not a leeway the founder can use anyway. But typically it's about founders who really love what they're doing, who spent about maybe 1 or 2 years trying to understand the problem, have gone and volunteered in companies, or have just given up a lot to kind of build on that idea. That is what typically I invest in personally.
Yeah, and maybe Payal, I'll just add, I think, 2020 is different to 2019 in many different ways. We all know that with COVID, but I think with startups, one of the differences has been really 2019 and probably 4 or 5 years before that was the era of growth at any cost, right? You show a lot of growth as a seed stage company, you're growing 30, 40% month on month. And even if your unit economics are, pretty poor in the early stages, people maybe would have bet on, a great team with great growth, right? I think in 2020, what has changed is viable unit economics. There's an over indexation on that, and both Alok and Shanti mentioned this, right? Is quality. So what actually we see is every week I meet several dozen companies, but I see a hand 2-3 amazing pitches, and usually they're in transactional related businesses, meaning e-commerce, could be consumer, could be B2B commerce, and they're amazing pitches. The problem is very clear, the team is amazing, but where it falls apart is on unit economics, right? So if you have 3% take rate and negative 5% contribution margin, you are not a 2020 company, and unfortunately these companies will not be able to raise. And so I just talked to somebody last week. They've been in the market for the last 8 weeks, and for the kind of team that it is, and the amazing pitch and the story and the deep insights, but the reality is the unit economics don't work, right? And so I think that's maybe at least a recent example of something that is not working today. So if you're in a business, if you're a seed stage company, but you've already launched, and let's say you're in a business that's sort of quote unquote a monetizing business, there are a lot of businesses where you don't monetize, which is fine in the early days. But if you're in the monetizing business and your unit economics are deeply negative, that is not a good place to be today, because you'll find that the investor appetite for businesses with deeply negative unit economics, even at seed stage, actually has pretty much evaporated. I don't know whether Shanti and Alok, you want to add to that at all, but that's at least from Surge what we're seeing. Okay, Payal, let's go to the next question.
Sure. So the next question is again for Alok and Shanti. Vivek is asking, he's saying that some business models inherently require more capital at an early stage, and there is a trade-off between continuing to bootstrap to reach a certain level versus raising capital and scaling up in less time. Alok and Shanti, how do you look at this?
So I think that part of the capital intensive businesses is just one part of the story, right? Like what we have talked about. I think it's again your ability to execute through that entire process. And I would really say today capital intensive businesses are not seeing a lot of capital coming in, because even if at early stage you need a lot of capital, you will also need a lot of capital to continue to grow the venture. Right? So your ability again to raise your follow-on capital after you have raised your seed round will then decide the success of the venture. So in these times, we have not seen a lot of capital intensive businesses raise the money. Of course, there are exceptions again based on the founder market fit, but that is where we are today.
Yeah, I think the investors' preferences can fluctuate fairly rapidly, right? So 2019, we were supporting high capital burn businesses. 2020 doesn't look like a good time to do that. Who knows what 2021 is going to look like, right? And you don't want to be chasing the tail, as far as fundraising is concerned. So I think the way to think about more capital intensive businesses is, what is it buying you? Is it buying some real strategic advantage, right? Market share for market share's sake is what is getting deprioritized, right? But if an entrepreneur can show us that the company is going to take high amounts of capital, but in turn is buying a strategic positioning in the marketplace, I do think that there is still appetite to do so. That case just needs to be far more stronger than saying we will acquire market share, and by virtue of that market share, we are then going to be an indispensable entity. But if capital can go towards reshaping marketplaces, fundamentally defining success. Remember, I've been in the VC business. Rajan now is. That is the only commodity that we are peddling, right? From our standpoint, if capital can make things work, what else would we want? But the issue is that there have been many cases where capital was thought to be a competitive advantage, a fundamental competitive advantage, not just incremental, and that has not panned out. So we just need a better answer to, why does this capital intensity pay off?
Okay. Anybody else wants to add anything here? Or I'll move on to the next one.
No, let's go to the next question, Payal.
Right. This is also for you, Alok. Rishabh is saying that you talked about how it's important to show in-depth knowledge about relevant markets when you're pitching to investors. As a fresh entrepreneur with no prior experience and nothing else to show founder market fit, he wants to know what else he can do to stand out.
Yeah, so I think in-depth knowledge of the market, of the customer, is a tool that you have, right? Younger entrepreneurs can also sometimes be more ambitious than the older ones, right? You haven't seen everything that can go wrong. You can be more ambitious in what you're targeting. However, it is a double-edged sword on that one, because you have to be able to then inspire the confidence to be able to execute, right? So someone was telling me this story in the morning. I didn't know about it. That the Khata Book founders went and lived in the same locality as their MSME customers, right, before they raised a penny or launched the product. Right now, imagine the kind of insights and empathy they're able to demonstrate in the pitch, right? Obviously, the content is far better, but it is impossible to stop that level of insight from coming out and reflecting itself in the pitch, right? So I always get asked of, do you have a bias towards IIT-IIM? And I'm like, sure, why not, right? Because there is something on that profile that tells me that this is potentially a great guy to back. And if you are not that, then please give me another reason why your insight should show me that you are a great person to back, right? So all of us need to earn our stripes. All of us need to earn our right to capital. If you don't have one, then you have to work harder at the other one. And I think for younger founders, a lot of that has to do with, how disruptively can you think? Do you really understand your customers? Have you spent time with them? And hence, can you have a unique perspective on how to solve for this problem rather than showing me a clone of another app that exists out there?
Right. Thank you. Next question to all of you. How do you manage conflict of interest between potential startups that you might be looking at and your existing portfolio companies?
I don't know, that's a simple one. I don't look at other startups that might conflict with what I've done before. Life is too short. I don't even want to, be in the gray areas there. So if you're saying that this is the business you're in my best judgment, if I think that might, even have a remote overlap with something I'm already doing, I won't do it. If those situations arise later, and they have in the past, where you did things not thinking that there was a potential conflict, but conflict arises as you go along, that is then a transparent discussion to be had with the entrepreneurs to, first communicate what is going on and then be able to seek a solution to that. But, most investors who are investing out there care deeply about their reputations. And hence, they have a very strong incentive to make sure they're not messing around.
Yeah, so in LetsVenture, we don't have a conflict because we are not a participant in the marketplace, right? So we don't have a fund. We are never going to launch a fund from LetsVenture. We are going to continue to stay a participant. Continue to stay an enabler to the marketplace. So we work with various angel investors. We work with the various funds to help them invest into companies, but we ourselves are not going to invest. And for me personally, I have literally stopped investing for the last 2 years. I think there's a lot to do just in LetsVenture. And I don't think, like what Alok said, I think life is short and we don't have time to take information from one founder to the other, because that basically means you have to be really plugged into the details of both the companies. And, and this is a very small ecosystem, Payal. So I think founders should recognize that, even investors realize that it's a very short, a small ecosystem, and everybody will come to know if you're trying to do that kind of behavior.
Absolutely.
And I think the word really travels quickly, right? Founders are pretty smart, and they will go and tell other people that you should stay away from these investors if they're kind of unethically trying to take away information.
Yeah, and I think speaking for Surge, which is a seed stage program, right? We'll do 30 to 40 companies a year. We won't invest in a direct competitor. So for instance, let's take Conversite is a SaaS company that's building a very interesting set of tools for Facebook admins to help brands access them and help the admins. If the next company comes along that's building that company, right, we obviously won't invest. But that being said, you have to keep in mind, like if you take a space like agri-tech, right, you could have hundreds of different companies. Their starting points could be very different, right? So the starting point, because we're investing at Surge at seed stage. So what we are looking at really is a starting point. But keep in mind that some of these companies over a period of time, most startups will pivot and they may end up in similar areas, right? But at the beginning, when we invest, if we see a company that's a direct competitor to one of the companies that we have invested in the last couple of cohorts, we would look at. And then obviously in our main fund, the Sequoia main funds, we are even more rigorous about that. I think we're already at 5:30. Shanti and Alok, are you okay with maybe 10 more minutes? We can take 2 more questions and then wrap. But if you need to go, that's fine too. How are you guys on time?
No, I'm good.
I'm good with the last couple of questions.
Yeah, let's take the last 2 questions, Payal, and then we can wrap.
Yes, thank you. So, in fact, Shanti did mention it's a small world, and Rajan, you talked about, not investing in competing companies, but few concerns remain about confidentiality. There's one question that says, when members of the founding team are still employed in other companies and also bootstrapping their startup, how can they pitch to Surge while ensuring that confidentiality is maintained?
Yeah, so look, I mean, at Surge we keep it confidential, right? The only team members that are going to look at a Surge application is the Surge team, right? So we have a team at Surge, an investing team at Surge, and we will look at the application. And you have our commitment that we'll keep it confidential. That's an easy one. I mean, we don't tell anybody that you've applied. The only person who knows that you've applied is you, and then we will get back to you whether we want to take it to the next level or whether we'd like to keep in touch.
Perfect. Next question is from Vishal. He wants to know, how do you identify the right angel investor for you? Beyond checking their portfolio, are there any other pointers to identify the right angel investor?
So on LetsVenture, we have a platform algorithm which matches the startup profile to the angel investor profile. So angel investors also say what are their preferred sectors of interest, right? They also have an antithesis on what they will not invest in. But a lot of them write agnostic, right? So they will look at anything which is early stage, because a lot of them don't have a very strong preference. But that is one. Second is, I think it is good as a founder to also go do your own homework in terms of just knowing what are your competitive companies, who are the people who have invested in those companies, and you should kind of LetsVenture has that profile on the platform where you can create a stealth profile. You can block investors from viewing that profile based on what investments they've made into competing companies, right? So, but from that perspective, it is just a matter of kind of taking that data set together and then seeing, who would be a good investor to kind of take money from. But that is just based on sectors, right? There are a lot of other factors you would look at. And like I mentioned earlier, it is a small world, and people know who are the investors who work more actively with founders. People also know who are the investors who always give advice and assume that the advice should be taken as an operating principle into the company, right? So there are people you want to stay away from. There are people you want to approach. I think that you will start knowing once you start fundraising.
Yeah, and in these days of heavily syndicated rounds, even at the angel stage, I think it is really important to establish that comfort with the lead investors.
Yes.
Right, because they are the ones who are going to work closely with you. What is their operating style? Are they proxying this as their startup journey? Are they in it for the right reason? I think all of those are great questions, can get resolved through ref checks and spending time with those leads. But one of the things which is also important is, many times the people who are following the investment are good to follow till such time things are okay, right? But you need to make sure that the way your agreements are structured and your lead is playing, they'll be able to control things if the startup is going through a rough patch, right? You don't want this to be a lead investor in good times and a pack of wolves in bad times. Platforms like LetsVenture, Indian Angel Network, through the agreement structure, tend to enforce those rights and privileges. But the interpersonal dynamics is something that is good to know, and you should know that the following investors are actually following the lead, and it's not a marriage of convenience.
Great. Thank you, Alok and Shanti. I think that brings us to the last question. I know there were a lot of other questions, everyone, and sorry we couldn't get to them. But as you keep coming to our webinar series, hopefully we'll be able to answer these questions. I think the last question is that Payal had just mentioned on chat is, which are some of the most powerful angel networks and individual angels, and how do we get access to such a database? I think the answer is pretty simple. Indian Angel Network is the world's largest angel network, and LetsVenture is Asia's largest online curated marketplace for startups and early stage angels and seed funds. So between those two platforms, you should be able to figure out who you need to go to. And the good thing is you are one of India's most active angel investors, Alok Mittal, who's here. So between them. All right. So Alok and Shanti, thank you very much for the time. I hope all of you found that very helpful. And before we wrap up, just wanted to give you a sneak preview into our final and fourth part. Part 4 of the webinar series. Next week, we'll talk about what happens in the term sheet. So let's say you went out, you've got a great story, you've got a great founding team, you're very clear with your pitch, you made the perfect pitch, and now you've got a set of investors who are interested. So what should you look for in your term sheet? What should you expect in your due diligence? To Shanti's point, how do you make sure that you actually have the data and the material ready so that your due diligence doesn't take months, it takes weeks? And all the other details. And this should be a very, very practical session. And I would say if you're a seed stage founder, this is an extremely important session for you to come to. This is actually a session that we run at Search. So this is actually we're bringing to you. In fact, all these sessions that we run, we're actually bringing to you at Search. Can you go back to the previous slide, Gautam? I just wanted to introduce our 2 speakers. So we have Ashwini Varma, who's a vice president for legal at Sequoia Capital India, and Sandeep Kaur, who leads portfolio finance at Sequoia Capital. So these are 2 very senior leaders we have with Sequoia Capital India. They'll be here and they'll actually go through what to look for in a seed term sheet. How do you prepare for diligence, especially as we are in an era of, you can't actually meet anybody. And finally, what are some of the financial and legal terms and conditions that you need to be aware of, right? We'll really get into some areas that are very, very important for you. So with that, go to the next slide, Gautam or Payal. With that, we'll bring this 3rd edition to an end. And again, if you're actually looking to raise your seed round, we'd love to hear from you. You can obviously, you should get yourself listed on LetsVenture, approach Shanti and her team. You should go to IAN. You should actually reach out to Alok. Now you know exactly how to get his attention. And we would also love to hear from you. And all you have to do is go to surgeahead.com and apply. So thanks, everyone, and have a great Saturday evening.
Thank you. Thank you.
Thanks, Rajan.
Thank you, Alok.